I made over $3,000 on a funded account trading my inversion fair value gap strategy. And in this video, I'm going to teach you step by step on how you can take the same exact trades that I did. Now, if we look on Google what a fair value gap is, this is the picture of what it looks like. And basically, it's this hidden gap where the first candle and the third candle of their wicks do not overlap, meaning the wick here and the wick here do not come down and overlap each other. And it creates something called a gap right here, gap in price. Same thing with our here. This is a bearish gap, this red candle, because this first candle, this wick, does not come all the way down and overlap this. If we take a look at some examples on the chart, an example of a fair value gap would be something like this, because you can clearly see this wick here. If I zoom, let me just zoom in a little bit. This wick here does not overlap this wick here. So it creates this hidden gap in price, and this is considered a bearish fair value gap. Now, let's take a look at an example of something that would be a bullish fair value gap. So an example of a bullish fair value gap would be something like here, where you can clearly see there's a wick here and a wick here, and you can see they don't overlap. So it creates this bullish hidden gap in price. And another thing that these can go by is an inefficiency. An inefficiency is another name for a gap or a fair value gap, and you can use these terms interchangeably. Now, what does it look like when a fair value gap is not created? Well, it looks like this right here. Okay, if you can see this first candle's wick and this third candle's wick, you can see that the low of this wick clearly overlaps the high of this wick. Okay, you can see this is not a gap. There's no gap here because this candle trades above the low of this candle. Okay, and you can just see there's just no gap here, versus here, this first candle does not trade above this third candle. Therefore, it creates that gap, like I said before. Now, when people typically trade a normal fair value gap, such as this, you're looking for a rejection off of a bearish fair value gap. So we're looking for a rejection off this. And off a bullish fair value gap, you're typically looking for a bounce. Because most traders learning what a fair value gap is, they are taught to long a bullish fair value gap and short a bearish fair value gap. So what do? Well, I do the opposite because most traders fail. So I actually wait for the fair value gap to get broken through or violated. And a great example happened actually this Friday. This was a bearish fair value gap. It was very, very obvious. You can see the first candle's wick here does not overlap the third candle's wick here. And what I kind of waited for is I waited for price to trade above, and I waited for the candle to close above this bearish gap. So I waited for this candle right here to close above the gap. And what does that tell me? That tells me that price should go higher. Why? Because here's the thing. When people are learning fair value gaps, they think, oh, I'm going to short this gap here. And what happens is they short it, and you can see we kind of wick down, but then we end up going back up. And this is where people, they get stopped out and they reverse their position and all their shorts get liquidated. And this is when price tends to really start to accelerate or move faster the other way. And this is when I usually take the trade. So my strategy is basically that. I basically wait for a bearish gap or a bearish imbalance, same thing, to get broken above. And then off of this candle, I will take a long. Now, this is the hourly time frame. I do not use this on the hourly time frame. I typically like the 1 to the 5 minute time frame the best for an inverse fair value gap. So without further ado, let's look at a few examples on the lower time frame. In example number 1, we can clearly see we get a bunch of chop here, and what happens here is we bounce or wick off of a bullish fair value gap here. Now, this did not get inversed. So what does that tell me? That tells me that price is likely to be bullish. Now, what's something that confirms our entry or tells me, okay, price is bullish, I'm going to enter now? Well, that's when I look for a bearish gap in this example, since we are bouncing off of a bullish gap and price is bullish. I look for a bearish gap to get inversed. So what do? I look for one, a fair value gap, and we need a good fair value gap. So I would say this is a pretty good one here. And if I just go in the replay mode, you can see we don't know if the fair value gap is going to form here because we haven't created that third candle yet. Now, when we see the third candle's wick does not trade above and overlap this wick here, okay, I know that this could be a good fair value gap to use if it breaks. Now, if it doesn't break, I wouldn't take the entry. So if we play price, you can see the next candle does close above. Therefore, I would take my entry. And for people wondering where the stop loss would go, I typically just do a stop loss if we close back below. Now, you can change this up. You can do it at the low, but it does definitely worsen the risk reward. And if you are correct, we should not even close below that fair value gap anyways. So you can maybe kind of guesstimate and do a stop loss around here. And in this example, I would be targeting this high for about a 1.3 R, and then I'd be targeting the next high for about a 3.29 R. So when this fair value gap here gets closed above, and I see, okay, we're bouncing from this gap here, then I know this is likely to be a good entry. So if we just play candles real quick, it hits the take profit beautifully, and you can clearly see that once this bearish gap gets closed above and we get good momentum through it, look how well price just accelerates. And this is why I love them so much. Now, most people, they actually are trying to short this. And this is just all the people getting liquidated, reversing their positions. That was a bullish example. Let's get into a bearish example. This is a bearish example. So in this example, we first have to identify the fair value gap. So in this case, it would be right here to right here, because you can see that first candle, that wick does not overlap this candle's wick. So you can see it creates a hidden gap. And what happens at first is price does hold the gap. Now we do wick below it, but wicks do not matter for an inverse fair value gap. We want to see a body close below it. So we can see we go back up, we take out the high one more time, and then price really starts to rally, and then, and more importantly, closes below the gap that held once before. So in this case, this would be a bearish entry. And some people are probably wondering, could you wait for a retrace? Yes, you could. It's up to you, but sometimes you might not get it. And what you do is you enter there, whether it be on the close or the retrace, and you target the next obvious low. So I would say this would be a good target. Maybe you could target lower. It doesn't matter. And that's where I'd cover the position. So this would be about a 1.4 R. So that is an example of a bullish and a bearish inverse fair value gap. This is all I trade. I do not use normal fair value gaps. And if you can truly master this art of this entry, along with a narrative, along with a bias, then you can definitely master the markets. If you want to check out more, such as my trades, such as any classes I do that may be free, click the link in my description. There's a free Discord link. I have over 15,000 members, and there's a lot of other people trading the same exact thing that I'm teaching you here in this video. And again, feel free to ask questions in the chat and check out some of my other socials, all by joining the Discord in the link in the description. Thank you guys for watching this video. I will see you in the next one.